Hello to all Trading Link partners. Happy weekend. It's time again for the weekly Trading Link trading sharing session. It is currently 1:35 a.m. Singapore time. We all know that the past week has been one of the most turbulent in recent financial history. This was marked by Trump's victory in the presidential election and the conclusion of the US election. First, let's review a few trading instruments. Regarding cryptocurrencies, we have consistently mentioned over the past few weeks that Trump's election win is one of the only factors this year that could push Bitcoin past its annual high and is something anticipated with optimism. Over the last 2 weeks, we noted the potential for a false breakout before the election results, with a quick retracement, and advised everyone to set stop-loss orders and manage risk through hedging between futures and spot markets. Since your futures contracts can quickly be stopped at cost, once a second breakout occurs, this movement might become validated. This is the current pattern we are seeing. This video summary can be seen as a validation of all the predictions we made in the past few weeks. All our previous conclusions have already been discussed, and this week's market movements allow us to verify the accuracy of our recent predictions. All our previous conclusions have already been discussed, and this week's market movements allow us to verify the accuracy of our recent predictions. What will be Bitcoin's next movement? We believe that following this major bullish candle, small bullish candles will continue in the coming days until all moving averages align upward. This includes the weekly level, and the opening of the entire Bollinger Band channel will continue upward. This bullish trend could potentially last a long time, even several months. The next peak could well exceed $100,000, with a very strong likelihood. The overall benefit to Bitcoin from this wave isn't because Trump supports cryptocurrency, but due to a package of policies he has, and how the US Federal Reserve plans to accumulate large amounts of cryptocurrency, and how cryptocurrency will be priced and defined in the latter stage of the US dollar's global dominance. This is a crucial national policy for the US, and the Federal Reserve holds the same perspective. While the overall benefit for Bitcoin is long-term, it's possible that many exchanges will exploit these volatile markets to squeeze positions, executing quick, repeated liquidations and forced sell-offs to cut losses and clear out retail investors. Currently, the market is concerned about inexperienced clients blindly rushing in. Recently, we have advised many traders against blindly going long. However, in the short term, there are still opportunities for further upward breakouts in the coming weeks. Let's look at another prominent asset, gold. Our perspective on gold has consistently been that it is entering a phase of significant correction. Before the NFP report, gold experienced a drop the night prior, followed by 3 days of horizontal consolidation. On election day, it saw a rapid decline, with an overall drop of about $150 over the past 7 days. This translated to a 15-fold profit, assuming a standard $10,000 account with a 0.1 to 0.2 lot size. Over the past week, you could have earned a return of 15% to 30%. We have actually been waiting a long time for this market trend. It's somewhat regrettable that we didn't establish positions at better levels at the spike top before the data was released. However, this doesn't impact the overall positioning and return. This correction in gold may be prolonged, though not necessarily swift. The cycle may extend over a considerable period. Gold has not corrected for 8 months. This overall correction we are witnessing is, since the upward waves from last year, gold now has approximately a 40-fold adjustment range at the quarterly chart level. Before New Year's, gold still has some favorable positions around $2,700 and $2,740, with approximately 30-fold potential returns. Don't be overly optimistic about this correction. For instance, if you missed out yesterday, then today's overall loss up to the overnight peak from the Fed's rate meeting could be around 7-fold. For example, if you went short with $10,000 at 0.1 lots and continued up to 1.5 lots, you might have already faced a margin call. This is why we always strictly control traders' positions. For gold, this long-term correction is now very clear from the K-line chart. For instance, on the daily chart level, this is the first time we're seeing a divergence with the 10-day, 20-day, and 40-day moving averages trending downward. Some may wonder why there hasn't been a massive drop. Every K-line trend needs to unfold step by step. You also need to consider the overall chart pattern. For instance, starting from next Monday's opening, the weekly line might be below 2,690. By Tuesday, it might fall below 26,540. Therefore, the entire weekly line reversal will still take time. It may even require support from the monthly chart level. In the short term, a bearish approach has been the primary strategy strategy in recent weeks. However, be cautious of a sudden upward spike during the opening of the Chinese domestic market. A spike from 2,690 to 2,720, approximately doubling. Personally, I find this movement somewhat unusual. After the opening of the Chinese domestic gold market, there was a rapid surge. In reality, this independent market movement is inconsistent with many fundamentals and technical aspects of the international market, and it is somewhat excessively abnormal. We can conclude with some certainty. For instance, since 9 p.m. tonight, there has been a surge of over 70,000 long positions, with an average price above 620. This may lead to difficulties in the coming weeks if you recklessly go long without a plan. Thus, the irregularity between domestic and international market trends. At times, this differentiation can create substantial investment risks, especially for domestic market investors, since, after all, it is still influenced and led by the international market. For domestic gold trends, be mindful of the risks of holding long positions. Recently, crude oil has been particularly disappointing with its sluggish trend. After October 25th, crude oil experienced a rapid gap up due to geopolitical tensions. In the past 10 days, there has been virtually no movement. The most evident sign of weakness is the lack of upward momentum. All moving averages have converged. This kind of pattern is rare and may occur only once every 1 to 2 years. This has recently resulted in the current formation. You can see that the range has essentially remained between 70 to 72. New traders might not be familiar with this asset type. For crude oil, we know that past daily fluctuations were around $5 to $6, filled with trading opportunities. However, its performance this year has been very poor. It serves as a warning that its future performance could be even worse. On the monthly chart level, the 5-month moving average has crossed below the 60-month moving average. The next phase for the US involves a stronger dollar and further measures to curb inflation. For the broader commodity sector, crude oil may experience significant declines in the coming months. We won't go into detail about the dollar, since we have consistently noted that. You can see the overall boost Trump's election has provided to the dollar. Following a technical pullback yesterday, it continued to rally today. At the weekly level, the previous high remains worth anticipating and could be surpassed. We won't delve into the various indices surges either, as these indices have recently shown. However, everyone should still be cautious of the risks from the ongoing bullish trend in precious metals. Secondly, avoid attempting to bottom fish in energy markets. Thirdly, spot cryptocurrency can be held long-term, with reaccumulation on pullbacks for a multi-month annual level strategy. Non-US currency forex positions can be moderately increased. The dollar is set to continue rising in the next phase. This is the overall summary. We have had significant gains over the past 2 weeks, so our traders are quite pleased. However, risk is always an inherent part of trading. We hope that those who didn't achieve ideal results in past trades won't lose confidence moving forward. We also hope for a slightly more stable market in the coming weeks, without excessive volatility. After all, we are approaching the end of the year. All funds and asset management products are likely reaching their closure and sale period. This will impact the annual returns as a whole. That is our overall summary. The past 2 weeks have been very eventful. We wish everyone even better results in their upcoming trades.